Up right where we left off, the only section of the statement of cash flows that we have left to do is our financing activities section. So the financing activities, just like the two sections before it, will start with the same title line that says what's about to happen, and that is I'm getting ready to show cash flows from financing activities. All right, so that's where I'll start, cash flows from financing activities. Now remember, as we saw back here, with what we looked at earlier. Financing activities specifically deals with obtaining resources from the owner or returning resources to them, stockholders' equity stuff, as well as obtaining resources from creditors or returning resources to them, long-term liabilities stuff. Okay. All right. So I know back here in my balance sheet, I can see that there's only 3 accounts left that I got to work with. So I'm pretty sure those should all be financing, but we can just verify. So what I have left here is common stock, contributed capital in excess of par, same as paid in capital in excess of par from the book, and retained earnings. So all 3 of these accounts are stockholders' equity accounts. So I know that they should all, if there's any effect of cash because of the difference in those accounts, the effect on cash should be as part of the statement of cash flows from financing activities. Okay. All right. So I'm going to take the same approach I took last time. All right. I'm going to go back here and I'm going to do some T accounts. All right. I'll do T accounts for the 3 accounts that are affected back there. All right. 3 financing activity accounts that I have. So I have common stock. I have paid in capital, or here, I'll keep it what it is, contributed capital in excess. I'll have to abbreviate so it'll fit on here. Yeah, I think you get the gist of it. And then I have one more, which is retained earnings. Retained earnings. All right, so I don't need this T account down here, just 3 of them. Let me get rid of this one, and then I can use this space for some journal entries that I want to make. All right, so common stock. Let's think about how these accounts are affected, right? So common stock is a stockholder's equity account, as are the others, which means they all have a beginning balance and an ending balance on the credit side this time. All right, so I can put these beginning balances and ending balances in each of these accounts. Okay, so let me think about common stock here first. Common stock. The only reason that common stock would increase, think about that for a second. The only reason that I've seen common stock increase, common stock, the actual account go up, would be if I issued more common stock. All right, so the issuance of common stock is going to make common stock go up. All right, and I can think about if it's in this common stock account, as we saw in chapter 13 when we were doing those journal entries, the common stock account would always go up by whatever the par value of that stock is. All right. The common stock account, as far as making it go down, we haven't seen any reason for the common stock account to go down, so there's no reason that I would start to show you that now. Right? I'm not going to throw any curveballs, all right? No tricks at you, all right? Technically, common stock would only go down if we retired common stock, which is not something we've dealt with, not something you'll have to worry about in here, all right? All right, contributed capital or paid in capital in excess of par. This is going to work the same way. The only reason it goes up is if we issued more stock. All right, and that would be anything we got in excess of par. All right, and then over here, our contributed capital would only go down for retirement. And like I said, we're not dealing with retirement, so I'm just going to delete those now. All right, just to get rid of any confusion. I know there's not going to be anything that goes in there. Okay. Let's deal with the common stock accounts, and then we'll fill in some more blanks with my retained earnings account. All right. So with common stock, I know common stock started with 837. All right. And if I look back at this balance sheet one more time, I can see that common stock ended with 873. All right. And I'm going to do contributed capital as well because these two kind of work hand in hand. So you got to look at them together. Contributed capital started with 243. And it ended with, if I look here, at 297. All right, so 243 and 297. Okay, so I'm going to take the same approach I took last time, all right? Let's look down at that additional information. Let's see what happened to common stock, all right? Let's see what extra information it has for me about common stock. So right here, extra information number 2 says 36 shares of common stock were issued for cash at $2.50 per share. 36 shares of common stock were issued for cash at $2.50 per share. So if I think about that journal entry, all right, I know I got cash, right? So I know cash will be debited. And the amount to debit cash would be for $2.50 times the 36 shares that I issued. 36 times 250. Gives me a total debit to cash of $90. All right, I know common stock would have to be credited. Common stock would have to be credited. My credit to common stock, if I look back here at the balance sheet, it tells me that common stock had a $1 par value. So I know I issued 36 shares. I know the par value is $1, so 36 times 1 tells me credit common stock would have to be for 36, which means that paid in capital or contributed capital in excess. All right, you got it. I think you know what that means from now on. I'll widen this out a little bit so it doesn't wrap down to that next line. My contributed capital in excess must be credited for the remainder. All right, so the remaining balance for contributed capital in excess would be 90 minus that 36, or 54. All right, so that's that journal entry that I would have prepared, journal entry that would have been prepared in order to record or issue this common stock. Okay, so I'm just going to fill in some blanks here. I'm going to fill in some blanks up here. First blank I want to fill in is on my statement of cash flows. All right, I know that this has to impact my statement of cash flows because I see cash in this journal entry right here. All right, so I know the impact of issuing common stock on my statement of cash flows is that cash went up, cash was debited, cash went up by $90. All right, so over here in my statement, I'll say exactly what happened. I issued common stock, and when I issued that common stock, cash went up by 90. So I'll say plus 90 there, plus 90, okay. All right, so if I look back here again, I took care of that. All right, so now let me just fill in some blanks and make sure I can verify these accounts. All right, so I know when I issued this common stock was credited for 36, so that's the blank I fill in here. And I know paid in capital in excess was credited for 54, so that's the blank I fill in there. Okay, so now let me take a look at this and make sure that it can all balance out here. So this account started with 837. I know that I just increased it by 36, which means the ending balance is 873, which is correct. I verified that one. All right, I know that contributed capital began with 243. I know that I increased it by 54, which gives me an ending balance of 297. Matches the ending balance that's in there. I can verify that one. Okay, so let me just check those off. Check off my common stock account. Check off my contributed capital in excess account. You can see there's just one more financing activity account that I need to work with, and it's that retained earnings number right there. All right, so retained earnings began with 132. Okay, so I can put that 132 in there. It ended with 266. I can put that 266 in there. All right, I know, if I think back to retained earnings, all right, there has only been one reason that we have credited retained earnings with everything that we have done. All right, so the only thing that can increase retained earnings, and it kind of makes sense, is if we retain more earnings. All right, so the earnings that business generates, we call that net income, is all closed here into this retained earnings account. So retained earnings goes up by net income. All right. Retained earnings has gone down. We've seen it go down a couple of times, actually. All right. But for us, for the statement of cash flow purposes, we're just going to put one thing in here. All right. So for us, the only thing that has made retained earnings go down that we're going to worry about is the declaration of dividends. So anytime we've declared dividends declared have always resulted in retained earnings going down. All right. So here's my blanks that I have then. All right. So I know it goes up by net income. It goes down anytime that I declare dividends. All right, so here is my problem, though. Here's my problem. All right, well, not my problem, but just something that I need to make sure I'm aware of. Net income had an impact on cash, but remember, we already showed that up here in my operating activities. That was the whole basis. That was the whole thing with my operating activity section, right? Just to show how net income affected cash. Okay, so we already took care of that. All right, now I can include it here, so I'll fill in my blank for it. So I know that net income, I can pull it again off the income statement. Net income was 302. So I can put that 302 in there. All right, now my declaration of dividends. Now, I got to be careful with this declaring dividends, all right? Because just because I've declared dividends, number one, doesn't mean that it was a cash dividend. Remember when we declared stock dividends, they have the same impact, which is that eventually they reduce retained earnings. So it could have been a declaration of stock dividends, which wouldn't affect cash. And just because I've declared dividends doesn't mean that I've paid them yet. Because remember, when we've declared dividends, we debited cash dividends and we credited dividends payable, right? But they don't actually result in the payment of cash until we reduce dividends payable and credit cash, right? So there's just a couple of things to look for. Make sure that number one, that it's cash dividends, and number two, make sure on your balance sheet you don't see a dividends payable account, because if you see a dividends payable account, then that means the amount of cash dividends that you paid might not necessarily be the same that you declared. All right, so for us in here, it should tell us in the extra information if the dividends were cash dividends or stock dividends. And it does. It tells us that we declared and paid $168 of cash dividends during that year. All right. So we got that number this time. Just a heads up, sometimes we won't get that number. So let me show you how that 168 was calculated. All right. Sometimes you're going to have to back into this number. So if I had to calculate it, the way that I'd do it is I would take 132, the beginning balance, and I'd add net income to it. All right, so that would tell me how much that I would have had in this retained earnings balance had I not declared any dividends. All right, so if I do some quick math in my head, I can see that that number is 434. All right, so I would have had 434 in this retained earnings account as an ending balance if I didn't declare any dividends. All right, clearly that's not true. I can see that my retained earnings ending balance is actually 266. So to figure out the amount of dividends that were declared, you can just subtract that ending balance out of there. And that gives me that same 168 number. Okay, so I know they were cash dividends. I know the amount was 168. So the last thing I want to do is just make sure I peek up in my balance sheet, make sure I don't see a dividends payable account. All right, and we already know that we don't see it there. We already said that we only have one other account that needed to be checked off, and that was retained earnings, which means that dividend that was declared, 168, must have also been paid. All right, so in here in my statement of cash flows, I will say paid cash dividends. Paid cash dividends. All right, so if I'm paying them, then I know the effect of cash is going down. So I'll put that negative 168 here in my statement of cash flows. All right, I just saw that the difference of the balance of retained earnings was verified. So I can check off retained earnings. Check it off. We took care of that one. Okay, so that means the only thing that's left, the only thing that I haven't checked off here in my balance sheet is cash. Once you know that cash is the only thing that's left, that means you should be ready to total this thing up and see if you did it right. So let's finish out our financing activity section here. So I know that in my financing activities here, the net result was negative $78, a positive 90 and negative 168 results in negative 78 there. So I'll say net cash, again because it's negative, I'll say used by financing activities. All right. So then I want to do one more total here. All right, so my total right here, total in this cell right here will be the total of each of these three activities. All right, so the operating activity number of 217, subtract out this negative 54 from investing, and then subtract out this negative 78 from financing. And what I get here is a positive 85. This positive 85, because it's a positive, I'll say that this is a net increase in cash. Net increase in cash. All right. Okay, so now I can verify my answer. I can check and make sure that it is right. So if I look at cash, cash started the year with 176 and it ended the year with 261. All right, so started with 176, ended with 261. All right, so I'm just do some quick math in here. So 261, my ending balance minus my beginning balance tells me that cash changed by, check that out, 85. Cash increased by $85 during that year. So we got it right. We did our statement of cash flows correctly. All right. So then to sum it up, to finish it all out, I just need two more lines down here at the bottom. I just want to say, here was my beginning cash balance as of 12/31/15. So on 12/31/15, I saw that my cash balance was 176. All right, and then my last line, cash balance 12/31/16. So on 12/31/16, I'll do the math even though I know that it's right, but it was 261. All right, I am done with my statement of cash flows. Let me put a $sign on this number. Let me underline it a couple of times to show that I am done with this statement of cash flows. All right, sorry, I'm using Excel for Mac, so I actually have to go in to my format my font to be able to underline it twice. Format cells, but I want to make sure I leave you on the right note. So I'll go ahead and do it. Font, underline, double accounting. There we go. Okay, and this is a completed statement of cash flows. All right, I hope that this helped you figure out how to prepare a full statement of cash flows. Again, the statement will throw a ton of different stuff at you. All right, you could be thrown any number of investing or financing accounts, but if you take this approach, you should be able to figure it out. Just remember, do a T account, understand how that T account changes, and then back into those numbers using the restructuring of those journal entries. All right, if you have any questions, please let me know.